There's a sentence a senior banking executive said recently that's never been said before in their entire career. Wealthy families are asking to move their money out of the country. Not because they're broke, because they're smart. A senior Citi executive who runs the bank's family office business recently said something she called a first in her entire career. Newly created American wealth is now routinely asking to book assets outside the United States. Switzerland, Singapore, places far from home. This isn't a handful of paranoid billionaires. Citi surveyed 346 family offices, the private investment arms of the world's wealthiest families, and found that 70% now hold direct private investments outside the traditional stock market, with 40% increasing that activity in just the past year. And it's not just Citi's clients. UBS surveyed family offices and found 60% are planning major changes to how they allocate their money in the next year, double the rate of the previous 5 years combined, the highest number UBS has ever recorded. Here's the specific detail that should catch your attention. Nearly 30% of these family offices are actively cutting, or considering cutting, their exposure to the US dollar. Wall Street has a name for this now: the de-dollarization trade. So why now? 3 reasons keep coming up, and they matter whether you're in New York or London. First, policy uncertainty. Tariffs shifting, tax rules changing, interest rate policy in flux. Wealthy families hate one thing more than risk. They hate not being able to predict the risk. Second, the AI bubble question we've been tracking on this channel. When the smartest capital in the world starts asking, "What if this doesn't pay off?" that capital starts building an exit before everyone else even sees the door. Third, and this one's bigger than money, it's people. UBS reported that 44% of billionaire clients under age 55 have physically relocated at least once in just the past 12 months. Researchers now estimate 165,000 millionaires will relocate globally in 2026, up from 142,000 the year before. Citi's own research projects over $3 trillion moving into hubs like Switzerland, Singapore, Hong Kong, and the UAE by 2029. Applications for golden visas and citizenship by investment programs are up more than 500% since the pandemic. Now, before this turns into a panic headline, here's the detail almost nobody reports, and it matters. American family offices didn't shrink their U.S. holdings. They actually raised their home country allocation from 86% to 88%. So this isn't wealthy people fleeing America. It's wealthy people refusing to have all their eggs in one basket, while keeping most of the eggs exactly where they've always been. That distinction matters because it tells you what this really is. Not fear, insurance. The same people who taught us the dine and dash pattern in IPOs, the same instinct we saw in private credit. It's showing up again here. Smart money doesn't wait for the crisis to hit before it hedges. It hedges quietly, months or years in advance, while everyone else is still reading the headlines. You don't need $3 trillion to learn from this. You need the same instinct. Ask where your exposure actually sits, not just your money, but your currency, your country, your concentration in any single bet, including your own home market, because the ultra-wealthy aren't leaving America. They're just making sure that if something breaks, they're not the only ones left standing in one place when it does. Subscribe if you'd rather understand where the smart money is moving before it becomes tomorrow's headline.